Hello, everybody. Welcome to Wealth Window. In the world of finance and investing, understanding how your money can grow over time is crucial. One of the most straightforward yet powerful tools to grasp this concept is the Rule of 72. This simple formula allows investors to estimate how long it will take for their investments to double, based on a fixed annual rate of return. By dividing 72 by the expected annual return percentage, you can quickly determine the number of years it will take for your investment to grow significantly. In this video, we will delve deeper into the Rule of 72 and its significance in the realm of finance. You can expect to learn not only how to apply this rule, but also the underlying principles of investment growth and the power of compounding. Compounding is the process where your investment earns returns on both the initial principal and the accumulated interest from previous periods. Understanding the Rule of 72 is vital for making informed financial decisions. It empowers you to set realistic investment goals and timelines, helping you to strategize effectively. Whether you are a seasoned investor or just starting out, grasping this rule can enhance your financial literacy and guide you towards smarter investment choices. So, stay tuned as we break down the Rule of 72 and explore how it can transform your approach to investing and wealth accumulation. The Rule of 72 is a simple yet effective formula used in finance to estimate the time it takes for an investment to double in value, based on a fixed annual rate of return. The formula is straightforward. You divide 72 by the annual interest rate or return percentage. For instance, if you expect an investment to yield an 8% return, you would calculate 72 divided by 8, which equals 9 years. This means it will take approximately 9 years for your investment to double. Now, let's look at some practical applications of the Rule of 72. Suppose you are considering investing in a stock that you believe will yield a 6% annual return. By applying the Rule of 72, you can quickly determine that it will take about 12 years for your investment to double, 72 divided by 6. Alternatively, if you find a mutual fund with a projected return of 12%, you can expect your investment to double in just 6 years, 72 divided by 12. These examples illustrate how the Rule of 72 can be a valuable tool for making informed investment decisions. Whether you are planning for retirement, saving for a major purchase, or simply looking to grow your wealth, understanding this rule can help you set realistic expectations and timelines for your financial goals. Let's now consider some applications in business. The Rule of 72 is not just a tool for individual investors. It has significant applications in the business world as well. Entrepreneurs can leverage this rule to project growth rates for their companies, helping them set realistic financial goals and timelines. For instance, if a startup anticipates a 15% annual growth rate, using the Rule of 72, they can estimate that it will take approximately 4.8 years for their revenue to double. This insight can guide strategic planning, resource allocation, and investment decisions. Moreover, the Rule of 72 is highly relevant when evaluating investment opportunities and associated risks. Business owners can use it to assess potential returns on investments in new projects, marketing campaigns, or technology upgrades. By estimating how long it will take for these investments to pay off, entrepreneurs can make more informed decisions about where to allocate their resources. For example, if a company is considering investing in a new product line with an expected return of 10%, they can quickly determine that it will take about 7.2 years for that investment to double, allowing them to weigh the potential benefits against the risks involved. Real-world examples abound of businesses that have successfully utilized the Rule of 72. Take, for instance, a tech startup that projected a 20% annual growth rate. By applying the Rule of 72, they anticipated doubling their revenue in just 3.6 years. This projection helped them attract investors who were eager to support a company with a clear growth trajectory. Similarly, established companies often use this rule to evaluate mergers and acquisitions, ensuring that the expected returns justify the investment. There are some limitations of this rule that should be considered, however. While the Rule of 72 is a handy tool for estimating investment doubling time, it is essential to recognize its limitations and misconceptions. One significant limitation is that the rule assumes a constant rate of return over time. In reality, investment returns can fluctuate due to market volatility, economic conditions, and other factors. For example, if an investor expects a 10% return but experiences a year of negative growth, the Rule of 72 will not accurately reflect the time it takes for their investment to double. This discrepancy can lead to overly optimistic projections and poor financial planning. Another critical factor to consider is the impact of varying interest rates on the rule's effectiveness. The Rule of 72 works best with interest rates between 6% and 10%. Outside this range, the estimates can become less reliable. For instance, at very high interest rates, the rule tends to underestimate the time required for doubling, while at very low rates, it may overestimate. This means that relying solely on the Rule of 72 for investments with extreme rates can lead to misguided expectations. In summary, the Rule of 72 is a powerful and accessible tool that plays a crucial role in understanding investment growth. By providing a simple formula to estimate how long it will take for an investment to double based on a fixed annual rate of return, this rule empowers both individual investors and business leaders to make informed financial decisions. Whether you are planning for retirement, evaluating investment opportunities, or strategizing for business growth, the Rule of 72 can help you set realistic expectations and timelines. We encourage you to apply this knowledge in your financial planning. Understanding how your investments can grow over time is vital for achieving your financial goals. That will wrap up this video. Subscribe and turn on notifications so you don't miss more videos related to business, personal finance, and much more. Together, we can foster a community of informed investors who are equipped to make smarter financial decisions. Thank you for watching, and we look forward to bringing you more valuable content in the future.